So thank you, Marty. Greatly appreciate it. I'm joining you, even though my background shows New York. I'm in Philadelphia. Wonderful day here in Philly. It's nice and sunny. But we're here today to talk about mergers and acquisition. And just to sort of set the table to a certain extent, Morgan Stanley posted its outlook for 2024. And a couple of themes I just want to run through quickly. Three areas where corporate activity is poised to strengthen is in energy, healthcare, and technology. And within technology, AI specifically. The return of financial buyers, they're predicting for this year as both buyers and sellers. Activist campaigns to push for even more M&A solutions. Corporate separation activities will certainly drive clarity at the corporate level, but also offer great opportunity one-offs out of different companies being spun off or carved out or whatever the mechanism might be. Regional economic woes are going to continue, and that's going to drive more cross-border opportunities for things. So fortunately, Marty's assembled a great group of people here who will be able to shed more light on these topics as we discuss this afternoon. We have Jay Freeman, who's the founder and managing partner of BlackView Advisors. We have Charlie Burns. Is Charlie here? Marty, is he going to participate today? Well, Marty's out of your shot. I don't see him in person, and I don't see him on screen. So Charlie is questionable here. John Murphy, who's there live in person and will be my eyes and ears. I appreciate that, John. He is a principal with Hanover Square Partners, and in all fairness, he clears through Pickwick, which is the firm I'm affiliated with. So John and I have had previous conversations and know each other. And then we have Kevin Swanson, founder of HawkEye Capital Partners. Again, my name is Mark Heil. I'll be moderating this panel. I'm managing director of Pickwick Capital Partners, a FINRA registered advisor to the middle market companies and asset funds with providing specialized strategic and transactional services. We provide a full range of investment banking and placement advisory services for public and privately held companies. For the next hours or so, we're going to be having a great conversation here. I invite you to be part of it. Out of consideration for our panelists, I'll ask you to, be brief with your questions, sort of get to the point as quickly as you can. If they need more context, they're not shy, and I'm not shy, so we'll ask for it if we need some more. With that, I want to do a quick disclaimer, then go into the introductions, have our panelists introduce themselves. So information presented is for educational purposes and is not intended as and may not be relied upon as tax, legal, investment, or other advice. To the extent myself or any of the panelists expresses an opinion as part of this discussion, those are personal opinions not necessarily shared by their firms. With that, I'd like to start with our panelists and have them do an introduction of themselves. Jay, I'm going to kick off with you. Would you do me the honor?
Thank you, Mark. Hello, I'm Jay Freeman. I'm founder and managing partner of BlackView Capital Advisors. We focus on middle market acquisitions, either control or minority investments with significant influence, industry agnostic. The only thing I guess I would say is we don't look at energy, retail, consumer goods, or life science discovery. Thank you for having me today.
John, would you follow up?
I'm going to move up here just so be sure you can hear me okay. Is that coming through clearly?
Yep.
My name is John Murphy. I'm founder and principal of Hanover Square Partners. We are a fintech and financial institutions focused capital solutions provider. So that includes M&A, fund placement, as well as capital raise.
Perfect. Kevin.
Well, thank you for the invitation to participate. I'm the founder and partner of HawkEye Capital Partners. We focus on lower middle market, but some context, my career has been 40 years in financial services across investment banking, private equity, and most recently a large Paulson and Company, a large hedge fund. So a pretty broad spectrum of experience. I started at Goldman Sachs, Solomon, Wasserstein. We did big deals. Now I've moved to the other end of the market. So I have reasonable reasonable background for this conversation.
Fantastic. Look forward to really tapping in and getting some of your insights. So, Kevin, I'm going to throw this one first at you. The M&A market in 2021 was red hot, and a lot of deals were getting done. And then 2023 came along and it was ice cold. What's 2024 looking like from your perspective? What should people expect?
Well, you know, I am not I'm not the eternal optimist that most people are, I guess. I think it will get better, and it will probably be meaningfully better, but I'm not as bullish on these interest rate cuts, which would be a strong signal. You know, one of the biggest factor in valuation, period, is interest rates. And I know people don't understand that, but if you go back and look historically, go way back to the early 60s, the 10-year Treasury bottomed at 4% in 1964. The Dow was 900. 18 years later, the Dow was 900, but the 10-year Treasury was 16%. So with interest rates going from 4 to 16, the market was effectively flat for 18 years. And then we started in 1982, interest rates started going down, and they basically went down pretty consistently until 2021. Now they've started ticking back up, and the market went from 900 to 36,000 or 37,000 or whatever. So interest rates drive value, and when you get a huge move in interest rates like we saw between the bottom and you know, when the 10-year hit 5%, that's going to be a massive problem for the M&A market, primarily because two things: valuation gap is created between buyers and sellers, which is very hard to close. Cost of capital goes up, so valuations have to go down. And sellers don't like to hear that. They believe their company is worth more than ever because it's performing well, and so they just sit on the sidelines. So we get a lack of sellers. It's very hard to close the valuation gap, and it dries up. Now, you are right. It dropped precipitously between 21 and 23. Globally, it was down over 50% in value, but actually the deal activity was down much less, maybe 15%. So there's still transactions getting done, and I think, and even if interest rates are just stable, even if they don't decline, I still think activity picks up this year. A major factor for that is private capital, right? Private capital must get investments made, particularly private equity. And if they don't, they go out of business. You're in the business of cycling capital. You have to buy and you have to sell, and both of those things slowed down in the last couple of years. So that money needs to get invested, and they also need to exit. And you know, in some of I'm not sure how much dry powder are. I've seen estimates of $2 to $4 trillion of dry powder in private capital, and the number of portfolio value is supposedly 12 trillion. So all that capital, something needs to happen, both buying and selling on both sides, to satisfy their objectives. So I think it's going to be a better year. I'm not as bullish as I think some people that it's going to be a massive recovery.
Yeah, I always have questions about dry powder and whether or not it becomes evaporative powder when LPs tell them not to invest their money for a period of time. So that's something I always look at. It is something, you know, we could always discuss, but I want to flip it over to John right now and just have John see if he had anything he wanted to add on there or tack on as far as what you said.
Well, first I just wanted to say, Kevin, I think we share a similar background. I was at Goldman 25 years ago, and I was also at Solomon. So
right.
we'll have to chat offline at some point.
You're younger than I am, though.
Maybe. I agree with everything that Kevin said. The one thing I'd say is maybe kind of looking back at last year, because of that violent rate increase that we saw, that really, you know, took a lot of people offline from selling assets. And so I think that those assets that have been held on to are going to have to be disposed of. And so I do see some increases this year, but to Kevin's point, I don't see it being a gangbuster year because, quite frankly, you know, we came into this year very excited by the about face that our Fed chairman took on rates. And then, we've seen that be extended, right? Where he's not actually talking about a rate decrease. I mean, he referenced it, but we keep seeing that get pushed out. If we look at the futures market, it went from March to June, and now we're looking at, 1 or 2, I think is the consensus. So I do think the pent up demand from last year will be broken up. If you look at the fund managers that we talked to, Mark, a lot of them, quite frankly, have to move those assets. They can't just sit on them. They have LPs that are forcing them to do things. I'm sure you both are seeing that from your clients as well. So I'm cautiously optimistic, but it's mainly from that pent up demand last year.
Yeah, and John, I want to touch on that because, according to Bain, there's $3.2 trillion in unrealized value represented by 28,000 unsold companies weighing down the portfolios of private equity firms. More than 40% of that is 4 years or older. So what are some of the mechanisms that are being used to help alleviate that log jam?
I think, what we're seeing and we're recommending, especially in the family office space, is reps and warranty insurance. I think that's a way to kind of break that log jam a little bit and also decrease the risk as well as the due diligence, getting stepped up for those family offices.
Are you seeing a lot of activity in the secondaries market, or also continuation funds have been something else? And maybe Jay wants to comment in here too. But why don't we start with John, then we'll go to Jay and get his thoughts on this.
Yeah, briefly, we're in the market, just full disclosure, since Mark and I work together, we are in the market with a couple different secondary funds. And so we are seeing interest from family offices as well as foundations to move into those secondary markets for private companies. I would call them, the super unicorns, or maybe the Pegasus is a better term, where those folks are raising money. Clearly, the IPO market has been extended out, so there's less of a ramp there for them. And so they're doing more secondary deals. And so that's what's giving rise to these secondary funds that we're working with.
Terrific. Jay?
So, yes, I think one of the things you mentioned was continuation funds. And I think we saw a lot of that kind of come online or just increase significantly during COVID, right? Companies, or particularly I'll say private equity firms, had a number of portfolio companies that they felt could last throughout the downturn that COVID created, but long-term thought that those companies are still very viable entities and did not want to sell them at low valuations. As Kevin mentioned earlier, there's still definitely a large disconnect between buyers and sellers in the market. I do, and I agree with the other two panelists in regards to what they said on the pace and velocity that we will see over the next year. I'll add in, I think, something that is also pretty significant that may even slow down the private equity markets. While they do have the ability to kind of move things off on the into their continuation funds and maybe even be forced sellers, we saw the denominator effect take place, right? So if we think about the larger firms, their ability to put capital to work or even raise new capital has been significantly different than the years past, because the part of private equity that is a significant portion of the pension funds, et cetera, of their total investment capital now has to change. So I think that's also going to play, at least for the private equity side, that's going to play a major part in what we see from private equity going into the M&A market. And I think if we think about strategic buyers, they're a little bit different. I think we could see a little bit more activity there as some of them figure out, hey, what's the company or the business unit that we have, and we've held on long enough. We do need to get cash, or we want to get cash. It doesn't look like interest rates are going to drop. I don't think that we're going to see a significant increase, but they need to get cash back on the books if they think that, we'll be even at this status for a while. So we could see some activity there. And I think as buyers and sellers just come into this environment of a realization that rates and prices, price inputs will start to stabilize, you could just see people starting to take a little bit of their medicine and come to that medium that Kevin spoke about, where the gap is right now. So I do think that those things will play a part in seeing some increase of activity. with corporates and private equity. But again, as the other two panelists spoke about, I don't see a significant increase, at least for 2024.
Well, picking up what Jay just said, Kevin, have you seen a lot in the way of spin-outs and carve-outs? I know you're dealing at the lower end of the market, and and it's a little bit different. But are you seeing a lot of activity, reading a lot of activity in that area?
Not really. No, not really. I agree with the point. Particularly the turnover in CEOs. I don't know what the current statistics are, but it happens more frequently than most people think. And a new CEO has an opportunity to reevaluate the portfolio of assets and take action, right? And raising cash is always good, particularly in a higher interest rate environment. Although most of the companies that are big enough to do this are not that concerned about interest rates because they're not that leveraged. There is a segment of the market, by the way, that is very leveraged. We haven't really commented on the distressed market. There's a substantial amount of high yield refinancing that needs to get done in the next couple of years, and it's going to be at significantly higher rates. And that potentially could create another source of deal flow if the pressure is too extreme. But no, I haven't seen it. I don't deal with large companies anymore, so I haven't really talked to people about disposing of unwanted businesses. The strategic multiples have dropped about 2.5 points, right, from over 12 to under 10. So value has been impacted dramatically, even in the strategic area, and I think that will at least give people pause. Now, obviously, if it's small enough and insignificant enough, or it's a distraction, people will do what they have to do. But I don't think I'm not really bullish on a big shift there either. I think it will pick up, but I don't think we're going to see a massive change in strategic portfolios.
John, do you concur with that, or do you have a different view?
I was going to say, because of our fintech focus and financial services, we're actually seeing the opposite. You can imagine that there's a lot of companies out there that we had been talking to, say, 2 years ago, Mark, and about a capital raise. And if they didn't do that, they're kind of running out of runway, and there's really only one option at that point, which is close or sell. And so we are seeing a significant amount of startups that are looking for that exit. One of the statements I've coined the last couple of years has been, you're not a company, you're a product. And so we can't sell your company, but we can sell your product. And we're trying to find those roll-up strategies that can take place for some of these companies that have really good products. But again, they're not, at the end of the day, standalone entities that can remain on their own. The other thing I'd say is that from a regulatory perspective, we're really seeing an incredible crush of financial innovation from the regulators. And so if you look at banking as a service, that's been really dismantled you see these cease and desist orders. I feel like they come out every week. There's a new one. And so the OCC and the Fed specifically have really clamped down on that. And so what we're also seeing is a lot of those banks that were initially taken over to provide banking as a service to those fintechs that we work with. We're now shopping some of those banks because that strategy is no longer viable, at least in this current environment, unless you're talking about a large institution that can kind of, quite frankly, get away with it with the regulators because they do a better job of it. But when you look at some of the smaller banks, which I won't name names, but you look at a lot of the ones that really pushed into this, and we're having a hard time keeping up with what the fintechs were doing with their charters. Those are the ones that are being dismantled and shut down, and those are the ones that we're presently out shopping. Coincidentally, it's interesting that we're seeing a lot of interest from family offices to move into these small banks as ways to provide different products for their family office as well as accounts. And then we're also seeing from wealth management companies interest because they want to do the same thing, which is add banking services to some of the financial planning that they're offering. So again, that's my narrow view. I think the broader view is correct, and that most people are just holding on for dear life with those assets.
John, ask a question. When you're talking about fintech, are you talking about like standalone fintech companies or fintech companies that are vendors to banks?
That's a great question, Marty. So it's actually both. So some of the companies that we're looking to sell right now, let's say, I'll give you one example, has a high yield account. And it was started by a bunch of hedge fund guys that I used to cover back in San Francisco 20 years ago. Super smart guys created a fantastic company, which is now a product. And so we're trying to sell that product to somewhere that can basically have better distribution. So in this case, we could sell it to a bank, we could sell it to an asset manager, or we could even sell it to another fintech. To your question, you know, is it standalone entities? So the answer is yes. In some cases, like in the case of these banks, you're seeing them try to get some kind of money for the one example is a bank that we're selling right now had spent $20 million on the technology in order to provide banking as a service to fintechs. We're shopping that technology at fractions of what it was, like 10 cents on the dollar, basically. So really, really remarkable what the regulators have done to a lot of these smaller banks that were providing banking as a service to the fintechs. Does that make sense?
Is the regulator role is what?
The regulator role is saying you bank can no longer rank your charter to the fintech who is say going out with a consumer product or a small business product. No more. And so to your question, yeah, that was actually a very good question when you talked about some of the intermediaries. So if you think of like Unit that provides credit card services to fintechs, they're having to change their business model. So the regulators no longer want a intermediary to sit in between a bank and a fintech or the consumer. They want to see that full A to Z approach from the bank. So those intermediaries are also for sale now because they have to be rolled up into that strategy I talked about.
Sorry, is that a new regulation or?
No, this is the regulators just exerting influence with cease and desist orders. If you read the orders, they're actually they're not based in reality. They're just telling these banks to stop.
Oh yeah, they can always tell a bank stop doing what you're doing.
Yeah, but there's no new regulation, Ron. There's nothing new.
It's just they're regulating by examination.
Exactly. And in some cases, you know, they do it in the newspapers, right? The same tactics that the SEC did, 10 years ago with hedge funds. It's unfortunate because what we're going to see is the U.S. as a whole lose our place because if you look at Europe, the open banking laws there are wide open and there's a huge sandbox there and they're not closing it down, whereas here they're closing down a lot of innovation.
Yeah, it's one of those unforeseen risks. Right, John? It's one of those unforeseen risks that you have in this area that you have, you know, here are the fintech companies out there and they're pushing. And then all of a sudden, you know, here steps in the government saying, you can't do that anymore, Mr. Bank. And now this fintech company's got to adjust.
What, anything happening in the broker-dealer space? I mean, you know, for years, all these crypto companies were told to put a broker-dealer in front of them, and now there's a couple of broker-dealers out them. Is that everything's copacetic there, or?
I haven't seen anything on the broker-dealer side. I don't know if the other panelists have seen anything there, but it's been pretty quiet on that front.
Then the broker-dealer side, you deal with, you know, the regulator can stop you to do anything on the digital side of things, meaning, you know, you need to have a special license to have, you know, accept, you know, token or accept, you know, currencies and stuff. FINRA that tells you flat out, or SEC, I don't need a special regulation for digital currencies. I'll just apply the SEC.
Well, we saw Coinbase win that huge case, right?
Oh yeah, well, there was a problem there.
You know, I will say on that front, Ron, that it is interesting how the regulators are moving forward with the ETFs, right, of some of the cryptos, right? You have BlackRock is probably going to end up being the largest ETF pretty soon here for Bitcoin. The way things are going, if you look at the assets that are moving into that ETF, it's pretty remarkable. So again, I think it's more of a scale thing. Like if you're small, you might have a problem. You might have a regulator knocking your door. But if you're, you know, BlackRock and, you know, being distributed by JP Morgan, you're probably okay.
I think the regulator is one, the big guy to sort of help them streamline the process. So that's why the smaller guys, you know, they try to slim them down because they don't have the capacity to look at it.
Well, and I think one of the things we're seeing, and not to dominate the conversation here about crypto.
No, it's about to say we got to get back on topic here on mergers and acquisitions, but
Well, all I would say in general is, you know, in reference to the M&A space, it is interesting how, you know, the regulators kind of dropped the ball, right? And so now they're over exerting themselves because of you know, basically dropped the ball. If you look at the Fed in San Francisco, there was a lot of culling there, and now, you know, they're going after everybody because of their post mistakes and not regulating as tightly as they would have hoped.
so with that, I'm going to move on to the sort of next point of conversation here. Morgan Stanley had said that energy, healthcare, and technology will be robust areas for people to invest in, and you know they're rather big. They're more like huge categories and rather specific sectors. So Jay, why don't you tell me which areas within those three you like and which areas you don't like? And Kevin, why don't you follow on?
Well, out of those three, if I had to pick one, I think for the size and the space that we play at in the middle markets, I would say healthcare. I believe that that's likely where you get the most value. As I mentioned, we don't participate in the energy space. I think that is just, you know, it's very up and down, commodity driven. Technology, I think it's a great space, but oftentimes there's a lack of value there. Multiples tend to be extremely high. I think as the gentleman who's on site mentioned, a lot of those companies also you tend to find out they may be better products than actual companies. So if I had to pick the three, I think healthcare, there are a number of places we're seeing roll-ups, whether it's dental offices, physician practices, hospitals, and things of that nature, where we think that there's a ton of opportunity. We think that there's value there. And when I speak of value, I don't mean just value from a purchase standpoint. I think there's opportunities to create value on the operational side. And if I may just take another moment, I think that is a big thing that we're seeing in lower middle market private equity, which is financial engineering, because there's so much capital and where interest rates have gone out the window. And investors really need to be focused on how they can acquire an asset and really drive value in that asset, not relying on financial engineering. So we at BlackView, we have a thing, we've got a tool which we call it's the cost and efficiency evaluator tool, and cost stands for capital. We find that most businesses either their capital structure or the way they utilize capital is highly inefficient. Their operating structure and operations are out of whack. The strategy is disconnected from where they are today and where they need to be in the future. And then a large part of that is technology. I mean, we still see companies that still have records, and their sales process is based on paper or Excel spreadsheets versus using applications, the cloud, et cetera, et cetera. So, and I think that permeates very highly in the healthcare services space. If you think about it, the electronic health records is a fairly new thing in the existence of the healthcare system. So there's a lot of opportunity to eradicate inefficiencies within the healthcare space for a number of entities. And, I think that there's a lot of value there, both from a price perspective and a value creation perspective.
I went to the doctor this morning, and then, midnight last night, I was typing in my new insurance information for him so it could get covered. So yes, very big space. Kevin, do you want to talk about what you're looking at, what you're excited about and what you're not excited about in those three sectors?
Well, a couple of things. Energy is the most difficult one because oil prices are volatile, and because oil prices are volatile, lenders in particular have a tough time. And so, when oil prices collapsed in whatever 2015, I think it was right at the end of 2014, 2015, whatever time it was, that created a huge shakeout, lots of bankruptcy, lots of problems. And then of course it recovered, and then it collapsed again. And at some point it gets very difficult for lenders to feel comfortable with the sector. And that's in fact happened. Lenders are no longer willing to lend the way they once were. And there's always a cycle, it'll probably change. But right now, energy's tough, and that creates a lot of M&A activity, right? Because they're companies with great assets that don't have adequate capital. It's the same kind of distressed selling that that we were talking about in the venture portfolios. You can't raise more money, you got to do something to get out of it. And so that's a very common theme in energy. There are some very big deals being done, because the other thing that has to happen is people have to have good assets. And if you don't have any in your portfolio, if you haven't been able to identify places to drill, you got to go buy them. And so there's going to continue to be a lot of activity in the energy space. But for anybody who isn't comfortable, doesn't know about it, hasn't spent a career in it, it's a tough space to get right. So as an from investment perspectives, I suspect a lot of people in your audience have a lot of experience in energy and will continue to invest in it and probably make money. But in general, I think it's a very tough space for new entrants. Technology is similarly difficult, but it is probably the most interesting space, because the demand for the assets is, I think, never been higher. Every corporation today, given the way things are changing, has to continuously evaluate where they stand versus competitors, and the market in general with respect to technology. And ideally, you don't have to buy it, but a lot of times you do. And so it's going to continue to be very active. I think it's a difficult investment space too, for that reason, though.
Yeah, I think you're right.
You know, there are a lot of things moving around. Healthcare is got all kinds of stuff in it. There's tech, there's devices, there's all kinds of stuff. And so it's a huge industry, and there's lots and lots of companies. So from an investor's perspective, it's very interesting. But you know, you got to make sure that you got a business model that works, and that the company is large enough to sort of either self-finance or get access to capital. Because as we've discussed, everyone's sort of discussed, without money, particularly for smaller companies, you're out of business.
Is there any particular place that you don't want to invest in within healthcare, or areas you avoid? And I don't mean you invest, but you introduce to investors.
I like the services business models the best. There are some very interesting companies in the technology related device companies. It just takes a long time and the one thing about healthcare that's interesting is the technology changes relatively quickly, which may not be something everybody appreciates. But you can have something that's the best thing since sliced bread, and it'll be obsolete in 3 or 4 years because somebody else is doing something, similar but better. And so you'll have an opportunity for a very short window. And so that obsolescence risk is real. And it's true in technology in general, but I think it's more true in healthcare than most people realize.
Yeah, and I'm actually going to throw this over to you, John, because we haven't touched on AI, and we're how many minutes into this conversation? So I'm going to ask you to comment on AI specifically, whether you think it's, and I guess the question's more along the line is, how do you spot the Google out of the crowd, right? Or the company that's going to sell the Google and be part of that engine?
Well, to Kevin's point, it's really hard to value these companies. And quite frankly, I don't think very many people really understand how these large language models work. I would say that it's like everything. The ones that are going to do well are the ones that have the most data. So if you think about what Google has, it's a treasure trove. If you think about what Microsoft has, it's a treasure trove. So these up and coming sort of smaller companies, I think, have to really narrow down their focus in order to become valuable. Once people start to understand that the value doesn't lie in the AI. I mean, Mark, I come from a tech background, and we've been using AI. Of course, we called it just learning models at the time. Machine learning is what the buzz was, 5-7 years ago. They're only it's garbage in, garbage out. They're only as good as the data, and so that's why I think these data providers, I think Apple is going to be probably the most interesting play. If you haven't heard anything from them, and there's a reason, right? Because they're smart. They purposely came out with the news of their automobile division shutting down, and I think they're just trying to keep away the focus on what they're doing, which really they're going to be the largest fintech pretty soon here if they keep moving the way they are. And then again, getting back to the data, they also have a very large treasure trove of data that neither Google or Microsoft had.
Yeah, I think your point
Sorry,
about,
why do you say Apple's going to be the largest fintech firm?
Well, if you think about it, Marty, they already have a card, right, with Goldman Sachs. They already have an account, so they're basically, you know, halfway there as a bank. So they already have payments, they already have cards, and then the next step will be lending, which they're starting to move into buy now, pay later. So they're just slowly, incrementally doing this, and I think eventually what will happen is you'll see them take over a bank charter, a large bank charter. You know, you see Goldman Sachs moving out of that alliance that they have with them. So, you know, we'll see how it goes. I mean, they're really trying to walk the regulatory tightrope. So they're in a tough spot.
Yeah, I mean, also makes the investment decision different if you're a conglomerate like that.
Yeah, exactly.
Right, 'cause the banks aren't highly valued right now, so.
But the fintechs still are. So
Are they?
Well, yeah, I mean, they're down significantly from last year, but still, if you know, do you want to be valued at 1 time or do you want to be valued at 5, 6 times? So that's the differential.
If I may hop in,
go on,
Sorry, go
please,
ahead.
Kevin.
No, I was just going to say one of the things that people don't really appreciate is the point that John just made. That the technology today is really a monopoly industry. These big companies have such a huge competitive. It's very, very difficult to compete with Google, Apple, Microsoft, and it's unfortunate, but it is, and it's going to continue to be that way. The only thing that the government has been relatively lax in approving merger and acquisition transactions that continue to give these companies that huge advantage, I think. Facebook acquiring Instagram, for example. Of course, they do it at technology in all industries. It's just we have not done a good job in this country, in my view, of regulating the M&A market. I think we've allowed way too much consolidation in certain sectors. There are 2 companies that basically own the cat food industry. Not that that's a huge industry to anybody, but they're basically 2 companies that own 90% market share in cat food. How is that a competitive industry?
Put that out for all animal food, right?
Yeah.
Regardless of what the feed is, they own it. They own that space,
Yeah.
The 2 of them do. Jay, with that background there, and
Can I just bring up one more point?
Sure.
Yeah, so, there was an interesting article, and I don't have it on me right now, but about how Mark Hurd, when he was running Hewlett-Packard, went on this real spending binge of mergers and acquisitions, and it was just a disaster. I mean, the company, he acquired a software company, and then he got replaced, and then Meg Whitman came in, and she didn't want to have anything to do with it. I think people discount that these large, these 7 large companies, they do lots of acquisitions. I mean, they do tons of acquisitions, right? It's because it's all about getting new technology that will fit on their platform they can distribute to their existing customer base, right? And I think people are discounting that there's when interest rates, when your cost of capital has increased so significantly with 7% interest rates, that the acquiring companies isn't as easy. I mean, maybe you guys can talk about that a little bit in terms of, the acquisition game isn't so easy when cost of capital is higher.
Well, that's a great point that you made, Marty, because if you think about the currency that fintechs have in terms of being overvalued versus, say, a bank, I mean, that's a huge differential. They're the strong hands right now, and I would say the banks are the weak hands.
Yeah, the other interesting thing was I'll relay a story from about 10 years ago when Apple bought out a startup, and the VC that sold the company to Apple said, I got right on the phone with that guy and told him he paid 2 to 3 times more than he should have, and I can help him negotiate the deals. And he said the response from Apple was, well, if I had done that, it would take me another 6 weeks to complete the deal, and it would have cost me 3 other deals. So you would have lost money for me. So I'd rather pay the premium and move on.
And all the bad deals that Apple and Google and Microsoft have done don't seem to have had that much adverse effect on them. So I don't think they're worried about, when you're buying smaller companies, when you're that big and you have that much money, none of them are leveraged. I mean, it's a big, to miss something is far worse than to overpay for something.
Exactly. Jay, do you have something to add here, or do you want to? I know you want to jump back to a point on AI, so feel free to do that now if you'd like.
Definitely. I wanted to speak to something that was said, and that's data. I think there are a lot of people who they hear AI and it's really, really sexy. But to the speaker's point, the fundamental part of AI is data, and do you have good quality data? And I think if you think about industries that are exciting, again, outside if we just take pure technology, it circles back to my point of healthcare. And you think about how much data sits in that space, right? Everyone from your local physician's office to CROs, which are entities that do research, and right, they've got to go out and get these findings. And I think it is interesting on how data is cultivated and what happens from a regulatory standpoint, but the data is there. There's a ton of data there that can make that space very interesting when we think about AI and what that can mean for the future. And so I wanted to circle back on how that could be very, very important.
I think you bring up a great point. I mean, one of the things I think that's got to be challenging for companies right now that are considering mergers and acquisitions of an AI type company or a company involving AI is how do you diligence them? And what are you seeing right now in the areas of diligence in, making sure the data is clean, but also getting a chance to really understand how the code works? Because we could see with what happened with Google not in the recent past, bad code can lead to bad results. Bad data can lead to bad results. How do you really diligence those opportunities?
I would just repeat what I said earlier, which is I think that the reps and warranty insurance is a good thing, and I think it's being utilized more and more. I think it's up at least 3 or 4% over last year. So when that gets deployed, you have a more robust due diligence process. It forces companies to bring in experts, right? I mean, and when you talk about AI, there's very few out there that really understand what's going on. And so in order to move forward with an M&A, say if you are a family office and you want to do something like that, to have that reps and warranty insurance and then therefore have to follow that due diligence process, I think really keeps people out of probably, at the end of the day, a lot of bad deals.
Kevin, anything to add to that?
Well, I think it's very difficult. I'm sure in a big technology company, first of all, they believe they can do anything. But but when I was in the earlier days, private equity, we bought a company and there was fraud involved, which we didn't uncover in the due diligence process. And we litigated. It was a public company that we bought. We litigated and we eventually got back our money. But that is a disaster for a private equity firm. And this is a very challenging area. You really have, and I'm not sure there's, the due diligence is no better than the people doing it. But some of these things are so challenging. To me, that's a very, very challenging question. I agree that with rep and warranty insurance, but I've never actually seen a case where anybody's actually tried to go get the money from the insurance company. Maybe John has. And so I don't know really know how well it works. I always recommend it. I think it's a good belt and suspenders approach, but it's just not a substitute for good due diligence. You raised a critical question, particularly in these technology plays.
I want to go back to something you brought up a little bit earlier, which was the difference in how people look at the seller versus the buyer and the gap that exists today. What mechanisms and Jay, maybe you want to lead off, what mechanisms are you putting in place in order to close that gap down and make a transaction more likely in terms of how you structure the deal, how you put it together?
I'm going to circle back to the last question, which is two things. One, I would say over the last couple of years, I've been part of two organizations who've designed technology due diligence tools. And I think back to Kevin's point, it's very important. The big players, they have their way of doing diligence. I think for family office investors, you really need to go out and find the experts who have the skill set to diligence those things. Everything from the code, right, the tech debt, et cetera, et cetera. I'll move off that point, but I do want to put the importance of that piece, and that's why that guarantee in our cost and efficiency thing is there. It's something that we look at very, very highly and deeply, not just for the growth, but hey, how is this thing going to operate once we get it? So I'll say that. To move on to the question you just recently asked, I think we are in an environment where deal structure is extremely important, and I think the key piece there is, we are seeing transactions that are very creative, which may be seller's note, and there are a couple of deals, and off the top of my head I can't remember, but there have been some deals out there from some of the larger firms where actually the companies have held on to a piece of the note to kind of just get the deal, get their balance sheet correct for the most part. So I think we are going to be in an environment where things need to be creative. Private companies, those companies you're going to see larger earnouts, larger portions of the deal being tied into seller notes. And then for some of the other entities, I think you'll see a lot around if the corporate entity can't hold, what you see from a transaction, a TSA, right? And saying, hey, listen, maybe we've got a longer time to move that entity off of our, what's currently sitting there from a shared services standpoint. Maybe the entity will have to put in a little bit more to assist the buyer in getting that off of, out of their entity. So I think you just see a lot of creativity around deal structure, not just financially, but also from an operational standpoint, to alleviate some of the pressures for buyers who are in this environment and possibly taking on some of that risk, given the fact that financing a deal is more difficult.
John, do you have anything to add to that?
So one of the things we're doing, Mark, is we're tranching up the deals. So we're basically starting with the risk priced a certain way, and then as that de-risking happens, the deal price can go up for the seller in order for them to hit those benchmarks and incentivize that.
Great. And Kevin, I'll give you just to see if there's any last rock or thing for people to think about here.
Using earnouts and all kinds of the tranching that John just said, all of those things are nice, but at the end of the day, it depends on how big the gap is. A former colleague of mine who now runs Stifel Nicholas M&A made a very good comment. He said when the price differential is 10%, you can usually get those deals done, but when it's 30%, it's pretty much never going to get done. And I think for the last year, it's been closer to the 30% most of the time. I think it's very difficult to get deals done. Now, a lot of deals did get done, but I think it's much harder to close the gap when it's that wide. And it gets that wide because when interest rates move that quickly, valuation comes down that quickly. Sellers don't adjust, right? They said my business was worth 10 times. Now you want to pay me 7. I don't get it. And I understand why. They're running a business. Their business is performing well, maybe better than ever. And yet somebody wants to pay them a lot less money for it. So that's a hard gap to close. Everybody should try, but I think that's a very hard gap to close. I think the only real solution is time. Time will solve it. Time and stability. If you have stable interest rates and enough time, the expectations will migrate towards somewhere in the middle.
One of the things is, I'm sorry, we're going to say something, Jay? Go right on.
I wanted to hop on the back end of that and just say, I think, if we talk about the lower end of the middle market, going back to Kevin's point about time, some of those sellers don't have time. If you think about baby boomers, et cetera, right? It's not the situation where it was before where, junior or the daughter is going to take over the business. They've gone off and they've become programmers or marketing executives at Google, et cetera. So they don't want to run the widget manufacturing company. But still, those people are aging out. They're looking to retire and they've got to sell their business. So with respect to that, I think at the lower end of the market, there's still quite a bit of opportunity for activity. Again, going back to where you can see a lot more flexibility in the creativity, because those people, they've just got to get the business off, right? They are looking to walk away. They're not just going to shut it down because their retirement is baked into that. So they don't have the luxury of time that maybe some of the more sophisticated and larger entities will have.
And when you run into a company like that, how do you have the discussion with them about, okay, here are the realities of life right now? Because oftentimes they're the ones that have a really high value on their company without any real knowledge. They just know their friend sold the business for 15 times what EBITDA was, and they should be able to do the same thing.
It is a unique point, right? It is, it's one of their children. Basically, they've had that business for, if they've had it for a significant period of time, 10, 15, 20, 30 years. So we're seeing, the longer of that for some, for the baby boomers, obviously, it's a very intense conversation because it's not just a financial transaction for them. They think about that. It's the thing that's allowed to put their kids through school. They've been able to buy a house, right? Grandkids, so on and so forth. So I think it's a very intimate conversation about, hey, listen, I understand this is where the market was, right? It's transitioned, but this is what it is today. And to Kevin's point, if you're 30% different on price valuation, then it's still, they're just going to have to wait to take their medicine. But if you're somewhere closer, it just goes back to, can you structure? Can can that be something that's put in based on a performance metric where, if it's 25, the gap is $5 million, you say, okay, well, how do we get there, right? You can't get that today, but if you meet these metrics on the back end, then, and they're incentivized to participate in that, then you can kind of close that gap. Whereas a buyer, you're not taking the risk because now you've made them perform into that additional valuation. And I think the human nature part of that is people, as long as it's within the timeline that they think they want to walk away from the business, most of the times, if it's not anything egregious on the performance metrics, they think that they can do it. So they'll sign up for that.
So we've talked about the impact of
I had a couple of questions.
Fire away, Marty.
Great. So I think Jay has brought up the issue of this retirement boom. And let me know if any of this data is correct. We had a panel on this pre-COVID in San Francisco, and they said that to sell your company, you probably need about $1 million in cash flow. Otherwise, it won't have much interest to the general acquisition buyers out there, right? And then you guys already mentioned several, earnouts, self-financing, things like that. So what does lead the boomers? I mean, at least there's assets out there to be sold, right? I mean, some may not have lots of cash flow, but they might have fantastic assets, right? Any thoughts on that for the boomers? I mean, what's going to happen to all those businesses that don't have $1 million in cash flow? Are they just going to fall by the wayside?
Well, I think it's much bigger number than that, personally. $1 million in cash flow is not going to get much interest.
Again, that was pre-COVID. That was pre-COVID, right? It's like modern inflation, right? So,
Yeah,
I'm not saying it's not saleable.
Annual recurring revenue of $1 million.
No, I meant cash flow, not recurring revenue. I'm talking about cash flow.
But I'm saying in the fintech space, you're not, there's not a lot of cash flow. You're really looking at just the model and how it's ramping and whether or not you can sell that.
Okay.
Yeah.
Well, that's a good point. But when during the telecom boom, when they were building all the fiber, I mean, the valuation model was, we pay for cash flow. If there's no cash flow, we want earnings, or maybe we want earnings. No, if there's earnings, we want earnings first, cash flow second, EBITDA third, gross margin fourth, revenues. If we don't have any of those, it's how much money you spent, right? So in the fiber boom, they were paying multiples of how much money you'd spend in putting fiber in the ground. So every asset is different, and this is is idiosyncratic. You have to look at it, but in general, $1 million. I mean, fintech is definitely different because it's an early stage industry, even though it's been around for quite a while. It's still relatively new and lots of new business models and so on. They may have very attractive features. They just haven't turned them into revenue and cash flow yet. But in more traditional businesses, which a lot of these baby boom businesses are, $1 million just ain't going to you're going to be selling it to another guy who's buying an income. You're not going to be selling it unless you've got something extraordinary. I think you got to be, frankly, 5 million in order to get real interest. Because without private equity today, for a lot of these businesses, which are not very sexy, somebody's playing the roll-up game if they're trying to create value with the asset. And so you need scale. Yes, if I own a business, I might find a tuck-in for a couple $1 million in cash flow that's very additive because I can eliminate all the cost structure or something. Yes, you can get those deals done, but It's not easy. You need some, if it's a standalone business and it's going to be operated as a standalone business, I think it needs to be at least 5 million in cash flow.
5 million.
So
That's my
Marty,
number.
See it,
Let's
we're
put it this way. I
working
will
with-
not take on an assignment to sell a company if it doesn't have 5 million in EBITDA, unless it is got some extraordinary technology. Because it's not that I have it's a good little business, but I just don't have any confidence I can get it done. And since I get paid when deals get done, I want to take on deals that I'm pretty confident can close.
Yeah, Marty, I would say maybe not. It doesn't fit this panel, and I'm also not going to say that it's going through, it's not gangbusters for that market. But what I will say is on a small scale, I'll use that as a preference, that there are opportunities out there. One of the things, there's search funds and or the model, which is ETA now, which is entrepreneurship through acquisition. And again, I don't think that's necessarily right for the people who are on this panel, but if there is someone out there with a business that sits in that space, what we are seeing is the traditional search fund model. That is, a young person who's just gone through their MBA program, graduated. They want to go out and acquire a business and run it and kind of become a CEO. And then one of the other things that we are seeing, and when I say we're seeing, it's just from the marketplace. It's not something that I'm looking at from an investment standpoint. It's just you travel in these circles and you hear and you see things. Are people who are mid-level, maybe they're a VP or something of that nature at a company. They've got some specific industry knowledge. They don't, they kind of want to sit back and take a role that's more of a CEO role, but it's not going to happen at a big company. And maybe from a lifestyle perspective, there's a lifestyle business that's available to them. So I think there are opportunities out there. But again, I would say that the in-depth part of that conversation isn't right for this panel. And it's not something where there are a ton of eligible buyers, but there are opportunities for those businesses of that size.
From the financial institutions perspective, there's 3,500 community banks out there. I'd say easily 2,000 of them don't really have a model that's going to be very valid going forward. So, Mark, we're probably internally that we have a roll-up strategy fund that we've raised money for that's buying those public banks, but we don't have one yet for private. And so I think that that's an opportunity for family offices. I'm kind of trying to create a syndicate where they go in and do a roll-up strategy, because at the end of the day, those banks, especially if they're family owned, kind of like we talked about, there isn't an exit. The children don't want to take over the bank. It might be a really good yet sleepy bank, and again, the multiples are so low. It's kind of hard.
But does it have a viable future? I'm just curious, in your opinion, do those institutions have a future? Do they have a role in the financial services space?
I will say, Kevin, that it doesn't look good for a lot of them. They might have some value if they're in kind of rural areas where maybe they are the only bank, and therefore they have a stable deposit base, and they're doing those rural loans through the government. But in terms of these kind of regional banks that don't really have anything to hang their hat on, just kind of jack of all trades, I don't really see a very good future for them unless they figure out how to really roll into a fintech strategy.
I have another question. So I think AI is an incredibly destructive force for employment. And I think it's terrible for banking. I mean, and I'll give you a great example. Morgan Stanley laid off a bunch of wealth managers recently, senior managers. And, when you're working with wealth managers or private banks, there's a lot of contracts. And the ability to consume those contracts now because of AI, you can do it in minutes or hours versus days and longer than that to really review lots of contracts from different vendors of the same service. And you can pretty much point out, what they're selling, et cetera. It's hard to differentiate. Those are products which are really hard to differentiate these days. So I think it's going to rip through financial services in a very negative way. Any thoughts on that in terms of how it's going to impact the mergers and acquisitions market? And I'm not talking about if you're a mergers and acquisitions professional. I'm talking about what kind of companies will be impacted positively by AI and which ones will be impacted negatively by AI? Thoughts?
I think of Klarna as a great example. They just came out, I think it was a couple of weeks ago, and they said they literally deployed AI, their buy now, pay later service, and it took the place of 700 employees. And not only that, but they actually had better metrics than humans in terms of being rated by the end consumer. So the point I was going to make is that, so you're going to have a lot of haves and have-nots. So if you deploy properly, like Klarna is going to go public soon, so perfect timing. But then if you look at those, if you go back to the community bank question, Kevin, is the community bank going to deploy AI in their branches or online? I mean, I just don't think that they have the capability to do so. So there's the have-nots.
Even if they do, there's no value in it. I don't see, the reason I asked the question is because I think this is partly generational too. My parents use one of those banks. My daughter won't, right? And it isn't because it's just a generational thing. I see no role for those banks in the future. And that's why I asked the question. I'm curious, you're an expert, I'm not, but I just think this is the generational impact of some of these things is huge. Our kids and grandkids are not going to be users of a lot of these businesses. I think AI is to get to this point though. I think AI is going to be beneficial to most businesses because it's going to reduce their costs. That's going to make them more profitable, and that's good. That's different than what it does to the employee base. Karl Marx may have ultimately gotten it right. We may go to the end result here where not that many people actually need to work. Because historically, whenever there's been a new thing, whenever something was dying, like agriculture gave way to industry and industry gave way to the white collar job market, but AI, I don't see what comes next, and maybe it's because I just am not visionary enough, but it just seems to me like there's a lot. It's not just financial services. Think about the accounting profession. I don't even know if we need the accounting profession anymore. It's going to have a dramatic effect on the white collar space in particular.
You're absolutely
so
right.
Services, service companies may not be a great buy. Yes, no?
Well, they're a great
companies?
buy because you can introduce AI and cut massive amount of cost out of them. I mean, I think AI is going to reduce costs for most companies if they get it right.
Yeah, but so in the past life, I led a group at a major bank warehouse, and all we did was we offshore jobs to places like India and the Philippines. But the question is, when you get rid of 50,000 people and their jobs in the USA, what happens? 50,000 people are actually salespeople for your company, right? So I think you might think, well, yeah, sure, I'm going to get my margin, but I've lost all my sales force.
Not necessarily, Marty. I got 2 AI companies. If you really want to play ball,
I am.
So my the computing speed, the programming side on the HR standpoint has dropped 80%. Right. On the other side of the coin, it's opened an enormous amount of opportunity for innovation where I need the software architect and engineer, the higher level guy, right? So do we displace the programmer per se? Let's say level 1 to level 3? Yes. But do I need the higher speed that, hey, you got to raise the bar. I really need to be an innovation side and not just a puncher, right? That is taken care of. So that on the energy market, we work at ERCOT. We use AI for ERCOT, the grid, right? We predict every single failure so far. So it's already there, but it raises the challenge for the human mind to raise your game 100%.
Well, and to your point, one of the things that I forgot to mention is that I think AI being deployed in the due diligence process is hugely valuable. Like, at the risk of offending our host, Scott, to your point, so a lot of those younger, first year legal minds that are doing a lot of those, tedious, redundant tasks, they get freed up to do more thinking, right? And to work with a senior partner and kind of solve the bigger problems, to your point.
Bigger problem strategy. I mean, AI is terrible at strategy. Anybody on the panel that said AI is still terrible at strategy. Yeah. We still need a human. We just got to
creativity.
But you don't need as many humans.
Yeah,
You
it's
don't need as
exactly
many
right.
humans.
Well, you know what? Then we do more biz dev and make the business bigger.
I have a question for the.
Yeah, I mean, the question was what businesses are going to be negatively impacted from a being acquired point of view versus positively impacted. So if you're a series of companies that fill in potholes and AI can predict potholes faster and better, then you're probably in great shape. But if you're a bunch of paper pushers and AI just took all of your jobs, then that's probably not a good thing. That's what I'm just trying to see what you guys think about. What are the businesses that people will be looking to acquire? You know, I'll
I
give a
think
great
it's going to
example.
be efficiencies, Marty. Where can you create the efficiencies using the AI? And that's going to be the driver, is the value of the AI. So back to
Just
Kevin's
as an example,
point.
I think in healthcare services, it's going to be huge. For example, I think it's going to be, there are going to be lots of, I think John made the most important point though, is you got to get it right. And that's hard in a new space. There are lots of mistakes that get made. And you know, bankruptcies and so all kinds of things, which is why if I could do it as an operator of a business, I would never choose to buy the technology. I'd rather use the technology and not have to own it, because when you own it, if you get it wrong, you know, the legacy impact's huge. But some businesses, you got to own it.
I think on that point, one thing that I didn't see a comment by the panel as a question, and it's probably missed here in the US more than in Europe, AI risk management, that the risks that AI creates for itself are massive. And Europe is ahead of us in terms of whether you like regulation or not. You can see Air Canada's situation. You can see Google. So I don't want to make this too long, but the reality is that if you're a quant guy, you know that Gen AI was introduced way before it was actually. It's like having a race car being given in the hands of 12-year-olds. So unfortunately, they decided to go ahead and popularize it, but it's a tool that will create a huge amount of, so there's any company you look at today, whether they're AI or not, you need to do an AI due diligence, because you got to read on what is referred to as AI ethics or ethical AI. Ethical AI is going to be here, and it's going to effectively, a lot of companies do not know their liabilities until these chatbots start telling people to do things that they're not supposed to.
Right. Yeah.
Hey, Ron, save some of that good stuff for tomorrow.
Yeah, I mean, I just answered that question for you. It's a matter of understanding that we're at the beginning of an industrial revolution that is way ahead of us.
Well, I'm going to give a great example. So now they have AI can produce movies, right? So right from the script, they can produce a movie with lifelike images, and that's just right now. In 5 years, with the growth of computerization power, it'll be able to do far more, right? So I mean, you know, that's to me that's as revolutionary as when, you know, 30 years ago there were 7 record companies and now there's 1, right? Because the technology became available to everybody, right? So does that mean you sell the movie businesses that are out there? I mean, I don't know. So I'm just trying to figure out where it all fits in the world. And what
just as an aside, I actually went on ChatGPT and asked it to, I gave it I said, please write a song for me about, and I gave it some stuff, and it wrote the song, and it wasn't bad. I mean, it didn't play the music, it was just lyrics, but it wasn't bad.
Since we're in Austin, did you ask it to write it in a Willie Nelson style?
No, I didn't tell it whether to be pop or country or whatever, but it was just lyrics. It was kind of cool though. Look, I think it's AI is like all new things. It's got pros and cons, but the pro from a business perspective is it's going to make things. You know, the flip side of these things though is that if we get massive unemployment as a result, that's not good for businesses either. So hopefully the transition to whatever it's going to be won't happen too radically, because massive dislocation will be bad.
we've got 2 or 3 minutes, Mark.
Okay, just fine. I was just waiting for this conversation to play out. I think we're good on all that. So, you know, we touched on this a bit earlier, but we didn't really go deeply into this. But the banking crisis was about a year ago when it happened, and then last week its ugly head showed up again with New York Community Bank. You know, Mnuchin had to put in $1 billion to stabilize that. So my first question is, do we think that's are we going to see more of these? And then how is that going to impact, you know, the availability of debt? And who's stepping in right now? Where are you going for the replacement for this? So we did touch on this, but I just want to have a further conversation about it.
Well,
And-
John, I mean, the next big thing, of course, is real estate, right? And I don't know how bad it is. John's probably the expert on this topic.
I wouldn't say I'm the expert because I'm not holding vast amounts of real estate, but I will say that the commercial real estate is a problem. I mean, if you look at New York City, I think everyone's spent time there at some point in their careers here. I would not want to be long office space in New York right now. I mean, we're seeing sales that are down 20, 40%. New York Community Bank, one of the reasons why they are having issues is, you know, guess what they took? They took the commercial real estate portfolio of one of the failed banks, and that was part of the deal. And you know, here we are, to your point, almost exactly a year later. So I do think that you know, the good news is Steve Mnuchin has a very good track record in terms of when he does take over a bank. He killed it with One West, which was IndyMac. So hopefully that'll be a harbinger for this deal.
I don't want to limit it to just that, but you know, when you're talking about going out and raising capital and getting a deal done and needing some debt as part of that deal, who's stepping in? Where are you going to now? Who's filling that gap? Or is it just obviously it's why it takes deals a lot longer right now to get completed? Is finding that debt, but
well, the private capital
there.
markets have gotten much bigger. I think that, I mean, I think it's a massive dollar amount now that they provide. It's hundreds of billions of dollars, maybe more, and they help a lot. But I think it's a problem. I don't know what the assets are in all those 30, however many it was, 3,500 banks. Did you say, John? That, I mean, I don't know what their total asset value is, but it's kind of got to be replaced eventually, I think.
I don't disagree, and I don't know the number off the top of my head, but I want to say, you know, 3 trillion.
The other thing that I think is happening, I don't know that anybody here does a lot of this, but you know, this world is getting smaller. And cross-border transactions have always been complicated because you're dealing with 2 sets of regulators, you're dealing with different you know, sometimes same central banking systems, sometimes it's not. So what are you doing in terms of what are you seeing in cross-border transactions? What's happening right now? And are you positive on them, negative on them, or where do you see all this?
I can answer quickly. Because of the regulators in the banking space, I'm working on a deal right now that's a Brazilian bank that wants to buy a national charter bank here in the States. I'd put it at 1% chance that I get that done. I have a Mexican bank doing the same that is very well connected politically. I think that one's maybe 10%. So I don't think it's the right opportunity. And again, I'm only talking from the financial services perspective.
Kevin, do you have any thoughts on this?
Yeah, I've spent a lot of time doing international deals when I was at bigger firms. They're hard. They are really hard. I don't think people should be doing them unless they've got the scale to be able. They're very comfortable. You got to be a pretty big company to acquire something overseas, in my opinion. I think. And is it always true? No, it's not always true. But you know, for example, for a medium-sized oil company to go buy something in Africa, I don't know if that's the best risk-adjusted investment strategy. So there's opportunity overseas for sure for the right companies. But I find it they don't work a lot of times. And so you got to be big enough. You just really got to be big enough.
Well, fantastic.
I will,
Jay, you're going to say something, Jay?
yeah, I was just going to hop in and say I agree, very difficult. But if you're seeing any activity anywhere, I'd say around anything industrial manufacturing, if COVID kind of highlighted anything, it was the importance of having some type of control and insight on supply chain. So again, I'm not sitting here to advise that companies do it that aren't of a certain, of a significant size, but I do think some of the players who are in that intermediary level are looking at opportunities to do those transactions if supply chain is very vital to their business and they're trying to find a way to have better control over it.
I think that's very true. Absolutely. So I think you guys have really knocked the ball out of the ballpark this afternoon. We went a little bit longer than what Marty had initially allotted, and I still have questions we could do, but I think we're at a good break point here, Marty. I want to thank you for this opportunity. Gentlemen, if you have any parting words, please take the time to say it now. Kevin, we'll start with you.
Thanks. I just want to say thanks so much for including me. It's been fun.
Terrific.
Thank you.
All right.
Thanks, Scott and Jackson Walker for hosting us. One thing that we didn't touch on, which I would just leave for the family offices, is that I see a lot of ESG fallout, specifically in energy, and I see family offices moving into that, and I think that's a great opportunity. We're working on a couple deals, Mark. So, shameless self-promotion there. The other thing I'd say also is that Hanover Square Partners is rolling out a marketplace for privates that is actually deploying AI so that when you do your due diligence on our deals, you can utilize the AI within our system. It has all the documents. It's very simple. This is not, anything groundbreaking, but it is nice to be able to look up fees and so forth in order to speed up the due diligence process. Thanks for hosting, Mark. And thank you, Mark.
And on that point, I'll just tell you, your ears must have been burning because right before this call, I was talking with Don, and he said we have to get with John and have a conversation. So be on alert. You'll be hearing from us in the next couple days.